Paul Moroz, welcome back to the Art of Boring.
Thanks, Rob. Thanks for having me.
Yes, well, I'm delighted to have you. I was going through the archives, or more specifically, I asked Chuck, our AI agent, to go back through the archives for me. And I think the last time you and I sat down or stood up, as it were, to do a podcast was 3 years ago. So it's been a while. Paul, many listeners will know that earlier this month, you were reappointed the lead manager of our global equity strategy portfolio that you launched back in 2009, led all the way until 2021. To start, in your words, what's led up to that decision that we took recently in that regard?
Well, we've gone through a rough patch in performance. There was a decision made in the organization to make a change, and I'm coming back in, and my colleague Dave Ragan is coming back in to help things out and make it better. So, these are difficult decisions that are taken. Um, we're pretty empathetic about what it means both for clients and the individuals involved. And the positive thing is, there's a lot of positive energy coming out of our organization about the decision. And I know I'm pretty excited to be working with the team again in public equities and back into looking at companies and making investments.
For you, Paul, I'm just curious with respect to your motivations and what it's been like coming back to the strategy.
Well, I mean, remember, I just really love business and I love investing and solving business problems. So, um, we'll talk about some of the changes later, but when I think about a business like TSMC, we own it in international, we own it in global equity, where all roads lead to TSMC in terms of producing chips. This is for listeners not familiar with the business, is Taiwan Semiconductors. They make the lion's share of profit of the entire industry in terms of actually manufacturing the semiconductors. Most companies can't even do that. We're talking years and years and years behind. They have an ecosystem that uh, makes it difficult for these chips to be replicated. And you can imagine even a new business like Nvidia, which is doing very well, very well. TSMC produces all their chips. Nvidia doesn't get paid unless TSMC ships. So these business models are really fun, and I was just enjoying engaging with the team and getting involved in them, solving business puzzles.
Certainly want to spend a bunch of this conversation focused on what you're doing and looking forwards. But if we could spend just a little bit more time looking backwards, performance is a reason leading up to the decision. From your perspective, Paul, performance wise, what has happened over the last, call it 18 to 24 months with the global strategy?
Yeah, performance is always difficult because remember, we're making investment decisions, a variety of strategies, and of course, it depends on the world that comes out and unfolds. So, as from a professional investing standpoint, you have to have a lot of humility recognizing that the world could have unfolded differently and we could be having a very different conversation. So that's the starting point. But what happened with the global equity strategy is performance result of some of the portfolio decisions made where the portfolio was a little bit more concentrated. It started to look a little bit more different than some of our other strategies. For listeners, we have the ability to invest in what we call unchained securities. That means a security that's not in one of the existing portfolios. And I think the portfolio was also a little bit more defensive when the world evolved such that maybe that defense wasn't needed. So there was a few things going on that resulted in the performance that had subsequently transpired.
Okay. And so presumably, since you were named lead manager a couple of weeks ago, this has, been all your time and energy. And I'm curious how you've prioritized things over the last couple of weeks coming back into the seat and what that's meant in terms of you and Dave and Manar and others working on a global strategy.
Yeah, a lot of this is back to the future, Rob. So some of the things that we're doing is looking at the portfolio and saying, Where is there perhaps uh, a place where we can diversify more, both in terms of places that might be in our other existing portfolios where there probably should be more overlap based on the wisdom of crowds. So Dave and I are spending a lot of time just working with our existing team and understanding their perspective. And really, we kind of play this aggregator function in terms of bringing up that wisdom and then making portfolio decisions that relate to that. So that's been a big part of it, onto about 50 names in the portfolio. And there's going to be more names and to the future. It improves the resilience of the portfolio. You have more chess pieces on the board, so to speak. We're trending towards a little bit more balanced in terms of the economic scenario. There's a technical team that some viewers might know, the beta of the portfolio, which is the sensitivity to the overall market. And the portfolio got down to a beta of 0.75, which was very defensive. And we recognize like, well, maybe there's going to be recession, maybe not. And so just for that balance and context, when I ran the portfolio, I think our beta on average averaged, between zero point 0.9, 0.95 in around that area. So a little, still a little bit defensive, less than one, but a little bit more balanced. So those are some of the things that we're doing to bring it back in line and maybe make it more resilient to other economic scenarios that might unfold.
I'd like to just go a little bit deeper on both of those things that you mentioned. So the first, just alignment with other portfolios. This is because we have a single investment philosophy and process it more. And so wisdom within other members of the team, you're looking to reflect that a bit more within the global strategy. Can you be more specific as to, what that looks like over the last couple weeks in practice? Maybe in terms of the additions that you've made to the portfolio.
Yeah, for sure. And let's talk maybe, in some themes. There's obviously lots of investment and development or evolution in the technology sector. So that's something where when we've looked at the portfolio, we noticed that we have less exposure to the technology sector, and a place where maybe there's emerging technologies that are pretty reasonably valued, really great companies, and have higher conviction in other portfolios that we can add to. So straight away that we've done. And likewise, there's some spots where maybe we have more consumer staples, and it's good to have some consumer staples, but we've been paring some of that back, and particularly if securities maybe are less represented in other portfolios. We're just kind of using that wisdom and adjusting that way.
Another shift, just looking at some of the recent activity that you've initiated in the portfolio that I've noticed is, and I'm wondering if you can articulate what this means to you, is shifting away from companies where the business fundamentals or the momentum of those business fundamentals is trending in a negative direction. And just wondering if you can expand on that.
This gets into the real technical aspect of valuing a company. As you can imagine, you're paying, let's say, 15 times earnings or 20 times earnings for a security, and you're building a discounted cash flow model and looking at scenarios, and you have this last earnings point that may be directed or trending upward or trending downward. That that trend, it makes a difference, and often it relates to the what I'd call the fundamental momentum, something that's really going on inside the business that's going to drive value in the future. It might be that you're winning a customer. It might be improvement on margins. It's it shows up from our perspective as modeling error, but it's really important to understand. So there's some companies that we've trimmed that that valuation is fair enough, but there's a few pieces where the business momentum was going the wrong way, and we thought the modeling error in valuation might be to the downside. And likewise, there's a few business models where things seem to be going really good. They're going from strength to strength, and we've emphasized those.
Does that align with your comments earlier about just underexposure in the technology sector in terms of where that business momentum might be positive?
A little bit, and it's important to know, you also have to be careful not to overdo it because there's businesses that, of course, have cyclicality embedded in them, have a fixed cost base. So, there's a cyclical element too. So, like in life, it's about moderation and balance. And I think that's important for listeners, our clients to really understand too, that we understand that.
On the topic of moderation and balance, can you speak to, you and Dave are now on the portfolio, you're working with the team, you've identified some spots where you feel like some shifts are necessary. How quickly are you moving towards those adjustments? And over what timeline do you think that clients can expect the transition to a Paul Moroz led portfolio to take place?
Yeah, that's a great question, Rob. Right now, we've made changes that touch about 7% of the portfolio. And as Dave and I and Manar look at the portfolio, we think that there's maybe another 7 or 8% in the foreseeable future that we can adjust. So I think the bulk of these changes are going to be made by uh, certainly the next month or so by the end of the quarter. But remember, it also depends what the market will give you. And of course, the market's always changing. All of a sudden, a security goes up or down. And so the valuation is adjusting, and you might make a different decision. So we recognize this feature of the market, and we'll adjust as the market adjusts and kind of take what the market will give us in making this transition. I think what listeners and clients should note is that both Dave and I have tended towards portfolio management of between turnover rates we're talking about now of between 10 and 20% a year. So, after these changes are made, we're going to settle down into that, I think, more typical uh, turnover that you've seen in the past when we're managing portfolios.
Paul, I'm curious, given your comments in the market and what it might give you with respect to trading, but just more broadly, it's been almost 5 years since you were lead manager of this strategy, and I'm curious as you step back and zoom out, thinking of the investment landscape, and I know we touched on technology, so that might be an element here. But I'm just curious, what are the big changes that you've noticed in markets, and what do they mean for a global equity strategy like ours?
Some of it's the same and some of it's different. So, what's the same? The decisions are still driven by people, and people are wired with all their perfections just like they were 1,000 years ago. And what's so fascinating, it'll always be fascinating about the stock market, it's the collective psychology of fear and greed and envy and all these emotions that people have that gets played out in the stock market. So that's the same. The market's different in that, again, we're evolving rapidly in technology. So AI is a new technology, and that's great. And it's just like any other technological a boom where you have investment, and are going to be winners. And this, in some places, it's going to go too far. I mean, we've seen this go back to the internet, go back to railroads, canals, whatever sort of technology it is. Um, you see similar trends. The structure is different. Passive versus active investing is a little bit different, almost to the point where there's certain securities that have, I'll call it a distribution advantage. They're in an index, and you have to recognize that moving in or out of that can create tremendous volatility. It creates differences in perhaps the cost of capital that where you see like discrete jumps. And then I think the market about value versus growth, and these debates are quite heated, but even over 5 years, I mean, there's just more and more business models that are capital light and maybe require fewer people to execute on them overall if you think about the scalability of those business models, and they can grow rapidly. So I'm a real believer in thinking about the world with real options and recognizing that these real options that you'll see in particular the US stock market shed light on what value there could be. And there's actually real value there if you understand the structures. Small cap markets are a little bit different now too. I mean, that's evolved since I was managing small cap years and years ago.
On the same theme, meaning you can
On the
scale a
same
lot
team,
quicker. Yeah. Okay.
sometimes again, but it depends. It actually just because a small cap security is small doesn't mean that it has outsized growth potential.
Mm,
It relates more to functions of, well, what type of business is it? How is the structure? You could actually have a company that's smaller in terms of number of employees, but it might be a mid-cap size company because of the scalability of its revenue model and business model.
got it. Paul, last words for clients. Again, recognizing it's been a number of years since you've been on this podcast in a global equity role.
Yeah, I mean, here's what I want people to know is that one, we we get it. It's been a little bit tough. It's been tough for a lot of the people across the organization too with this change. And I want to thank everyone involved, both in the transition across the organization, and just want to leave to you that both Dave and I are pretty excited to be back and energized with the team, and so it's just something that we really do both love to do, and we're going to be working hard to make things better. So thank you to all of our clients, everyone across the team, and thanks for having me on the podcast, Rob. Appreciate it.
Very good. Well, I reiterate that appreciation to listeners and clients. And Paul, I'm sure we'll see you again soon on this very same channel.
Thanks, Rob.